Hi, everyone. Welcome to the Seattle Angel Conference Workshop Series. We run these as a part of our effort to build more angels and more investable startups. Today, we have Joe Wallin talking with us. Joe is active startup lawyer in the Seattle area, writes the Startup Law blog, and has been one of the most inventive of the lawyers that I know in the Seattle area. And we're going to talk about a thing that is very important for angel investors to know about, and as a consequence is also then very important for startups to know about, which is QSBS. And there's been recent changes to that.
Thanks, John. Yeah, my name's Joe Wallin, and I'm an early stage company tech lawyer in Seattle, and I've been doing this since I got licensed as a lawyer in Seattle or in Washington in 1994, and originally started my career I thought I wanted to be a tax lawyer, and so I went to after law school I clerked for a judge for a year as an appellate court clerk, and that was great, and then I went to NYU and got the master's in tax law degree, and then went to work for Arthur Anderson and doing primarily like tax oriented things there. And I was there maybe a year when I decided I didn't really want to be in an accounting firm for the rest of my life. So moved to a law firm. And then, somewhere around, 96, 97, 98, somewhere in there, I met a fun loving group of corporate transaction, startup early stage company attorneys. And I decided, well, I think tax is great, but I'd rather be a corporate finance person. And so sort of migrated in that direction. And then you see, I was at DLA Piper, what's now the law firm that's now known as DLA Piper. I was there for, I don't know, I was there at the predecessor company, Gray Carey. I was one of the 7 lawyers or something that opened originally the Gray Carey office in Seattle in the year 2000. And then Gray Carey merged into DLA Piper. Yeah, we opened that office. I think the NASDAQ, we opened it in like maybe March of 2000, and the Nasdaq was like a 5,400 or something then. And then and then in April, we had the dot-com crash, and the Nasdaq went all the way down to like 1,400 and stayed there for a long time. But despite that, we were busy and we continued to be busy and grew the office. And then I eventually went to Davis Wright. And then after about 8 years there, I decided I don't need to be a giant law firm, and I joined Carney Badley in Spellman, which is a Seattle-only firm. We're about usually somewhere around 45 lawyers, 100 people total, or fewer than 100 people total. So it's a great spot to be. I built a great team here. I've got about a dozen people who work with me on early stage companies, growth companies, startups. We also do we're counsel to investors as well as companies, and counsels to lenders. We do a lot of loan transactions of one kind or another. I've been involved in, as John said, I've been involved in, there's been a lot of creative energy in the legal space, the early stage company legal space. There's been a lot of creative energy there. And so been involved in a lot of fun things over the last, 30 years, I guess it's been, including, revenue loans, crowdfund, the SAFE. We're going to talk about the SAFE today a little bit. I wasn't involved in the creation of the thing, but I've been around to see all these innovations in this industry, and it's been a great time to be a part of it. Unfortunately for all of us, founders and investors, the legal side has improved considerably in terms of like getting the work done from a legal point of view and documenting transactions and things. It has become much more technology enabled and a lot better. But today we're going to talk about the latest changes to the qualified small business stock rules. And if you didn't hear, you might not have heard, because this just passed, the so-called One Big Beautiful Bill Act, or the OBBBA, I guess is the formal title of it. That bill made some changes to Section 1202 of the Internal Revenue Code, which is the section which creates this sort of tax, this very favorable tax exemption available for what is called qualified small business stock. And so let me give you a quick primer on that before we go into the changes. But basically, qualified small business stock is stock in a C corporation, which is engaged in a qualifying trade or business, and has less than The old rule was less than $50 million in gross assets, both before and after your investment. Qualified trader business means a business other than a personal services business in the industry is like lawyering or actuarial services. There's a list in Section 1202 of businesses that don't qualify and can't take advantage of Section 1202. And it's always good when you're asking yourself the question like, hey, does this business engaged in, would it qualify as a qualifying trader business under 1202 such that I could get this tax exemption under Section 1202? It's always good to go back and look at the list in 1202 and things like hotels, motels, restaurants, bars, mineral extraction businesses, professional services businesses. There's many businesses which don't qualify, but happily for us in the tech industry, generally speaking, technology businesses are going to qualify for the 1202 exemption. So if you have a software as a service startup or you have an AI startup, these are businesses which are going to qualify for this tax exemption. So the way the tax exemption works is, let's just do an example. Let's say John and I decide to start a new company, a new startup. Say we're going to build a SaaS product. If John and I start a C corporation together and we each issue each other an equal number of shares, and we're actively engaged in that qualified trader business, if we hold our shares for 5 years or more, we can exclude up to $10 million of the capital gain from tax entirely on the sale of the stock. And so this is a big, that's a couple $1 million in tax savings at current rates if we each had $10 million in gain. So it's a big incentive to set up your company as a C corporation. And, probably many of you, or maybe all of you, haven't spent a lot of time thinking about tax policy or the history of tax policy. But like, if you go way back in time to when this idea first came into the Internal Revenue Code, I think the genesis of 1202, as it was originally constructed, was the government wanted to provide an incentive for people to conduct their businesses in the C corporation format. And the reason why the government wanted that was because C corporations better sources of tax revenue than some of the other choices you have, LLCs, taxes, partnerships, or back in those days, partnerships, S corporations. These are entities which maybe don't have the same incidence of tax reporting that C corporations do. And so there was very much back in the day, and you can go, chat with the robots or test me in my history. Back in the day, this was a move to induce people into a format that the government thought was better for the government in terms of revenue generation. Payroll tax reporting, income tax collection, withholding. And the way it was originally set up was you used to get a 50% rake, what was in the intermediate capital gains tax rate of 28%. So if you read, I know probably none of you are tax geeks, maybe, I don't know. I was a tax nerd or geek or whatever you want to call me, someone who loved to read the tax code. If you read section 1H of the tax code, which sets forth the capital gains, sort of schematic, there is a multiple different capital gains rates. Like, for example, there's a capital gains rate applicable to collectibles that's different from the capital gains tax rate for stock you've held for more than a year. There is a 28% intermediate long-term capital gains tax rate applicable. It used to be applicable to the qualified small business stock. You get a 50% tax break on a 28% tax rate. So you get down to 14%. That 50% exclusion under 1202 used to be considered what was called an alternative minimum tax adjustment. So I don't know if you're all familiar with the alternative minimum tax or not, but this was a tax regime put into place, I believe, during the Kennedy years. And the idea was, hey, there's some wealthy people out there who aren't paying any taxes, and that's unfair. And so we're going to create a separate tax regime. And the way it's going to work is you're going to prepare your 1040, and you're going to calculate how much you owe under the ordinary tax regime. And you're going to get a number, like I owe whatever, 100 grand. Then you're going to go and you're going to start with your taxable income in the ordinary tax regime, and you're going to go over to the AMT regime, and you're going to add back things that were maybe excluded under this regime, like tax-exempt bond interest. And there's a collection of things that are considered AMT adjustments. So we're going to take your ordinary taxable income, and then we're going to make adjustments to it, and we're going to calculate this thing called your alternative minimum taxable income. And then we're going to apply a flat tax rate to your alternative minimum taxable income. And it used to be there's two rates. There was like a 26% rate and a 28% rate. My recollection might be wrong, but you would multiply, whatever, depending on how much alternative minimum taxable income you had, you would multiply that by this flat rate, and you would get a tax owed amount. And then what you would do is you'd pay you pay the greater of either the tax owed under the AMT regime or the tax owed under the ordinary regime. So it's a long way of saying that if you got a 50% tax break on a 28% rate, and that 50% exclusion was an AMT adjustment, your effective tax rate on that was going to be something north of 14% when you accounted for the AMT adjustment at a very high level. And that wasn't for a time period in my career. We had 15% long-term capital gains tax rates, I believe, under first Bush regime or the second Bush presidency, I've forgotten which. But if you were thinking about this problem, like, hey, you got a 15% long-term capital gains tax rate, and you can get a little bit lower than that if you qualify for 1202. It wasn't that exciting because it wasn't that big of a differential between 15% and 14.3% or whatever it was. But what happened was, of course, as things evolved, the long-term capital gains tax rate has gone up. We also have another layer on top of the long-term capital gains tax rate for the Obamacare, surcharge of 3.8% if you're over $250,000 in income. And so anyway, capital gains tax rates went up. And then it was really Obama, who breathed sort of life, I would say breathed new life into Section 1202, because he was a proponent of making the 1202 exclusion a 100% exclusion, as opposed to a 50% exclusion on a 28% rate. And so that happened. Anyway, you can check my history, but I believe in like the early years of the first Obama presidency, I believe they enacted the 100% exclusion, but they didn't do anything to the AMT adjustment. And so what happened was you got an 100% exclusion, but then you had a AMT adjustment. And the first 100% exclusion period, like when Obama first did this, I think it was a temporary. It only lasted a couple of years. Maybe it only lasted a year. It was designed to get the economy moving again. But ultimately what happened was they made it permanent, and then they stamped out the AMT adjustment on top of it. And so it became a 100% exclusion for both ordinary and AMT purposes, up to $10 million if you hold C corporation stock engaged in a qualified trade or business that you acquired both before and immediately after you acquired the stock. It had to have less than $50 million in gross assets, the business. Like most businesses, the early stage tech companies starting out, don't have anywhere near $50 million in assets. So anyway, this became a big inducement to form your startups as a C corporation. And the other possibilities, setting up your company as an LLC, taxed as a partnership, or maybe an LLC taxed as an S corporation, or a state law corporation taxed as an S corporation. You basically have three choices when you're deciding which entity to choose how to set up your company. Today, you have LLC taxed as a partnership, or you have an entity taxed as an S corporation, either an LLC or a state law corporation, or you have a C corporation. Anyway, this 1202 exclusion up to $10 million for stock held for 5 or more years is a big inducement to go into the C corp format. Conveniently, it also LLCs, taxes, partnerships are just really complex. And if you're doing a startup company and you're trying to raise money from investors, usually investors don't want to get a K1. So they don't want to invest in an S corp or a LLC taxed as a partnership because they don't want to get a K1 usually. And if you think about this makes sense because, for example, if John and I form a SaaS company and we're just like making tons of money and you want to come and invest in us, and we're taxed as an LLC, taxed as a partnership, and you're a Washington resident, you might end up getting a K1 from our LLC taxed as a partnership from California. And you might suddenly have to pay, in addition to getting a K1 for federal income tax purposes, you might get a K1 for state law purposes, and then you might have to pay state income taxes somewhere you don't want to do it. So anyway, the C corporation format, and there are also problems with foreign or non-US investors in partnerships. And of course, S corps can't have a VC as an investor. They can only have individual shareholders. So anyway, the whole world tilts toward set up your company as a C corp. And then what we've seen over the last 20 years or 25 years or 30 years in startup land is there's just been all the open source document sets, everything's set up for Delaware C corporations, the SAFE, the MVCA documents, the Series C documents, everything's formatted Delaware C Corp. And that conveniently kind of all makes sense, because usually what you're doing with these startup scenarios is you're building a company with the attempt to not operate it for cash flow, but reinvest everything you can, and all the capital you can raise, reinvest it to grow the company as big as you can in, as quickly as you can, so that you can sell it and you can make a long-term capital gain and potentially have a tax-free long-term capital gain. So that's sort of the 1202, landscape generally. And what happened last, I guess it was a few weeks ago now already, with this One Big Beautiful Bill Act, was Congress made some improvements in the Section 1202 regime. And those improvements were, rather than having a 5-year, you got to hold it 5 years to get 100% exclusion, the rules have now changed so that if you hold stock that's qualified small business stock that you acquire after July 4th, 2025, after 3 years, you can get a 50% exclusion, and there's no AMT adjustment on any of these exclusions. After 4 years, you can get a 75% exclusion, and after 5 years, you still get the 100% exclusion. So they introduced this idea of getting some benefit after 3 years and some more benefit after 4 years, and still 100% after 5 years. They also took the $10 million exclusion amount and they've made it $15 million. And then they took the $50 million gross assets test and they've made it $75 million. And they've subjected the $15 and the $75 million thresholds to inflation adjustments starting in 2027. So these amounts will go up over time slowly. So these are, generally speaking, I think people are pleased with the changes. There are still, questions people have about how things work. One thing, by the way, that I should mention too, that came along with the Big Beautiful Bill Act, intertwines with this, is Congress fixed the Section 174 research and development expense problem. And if you were not are not a tax, person, you might not be aware of this, but like a few years ago, there was a change made which basically said you had to capitalize and amortize your software development expenses. So historically, what transpires is, like, going back to the example for John and I, we're going to start a SaaS company. Well, the first thing we're going to do, if it's John and me, is we're going to hire somebody to build it, right? Because I don't think John and I are going to be coding it. So we're going to hire someone, we're going to raise some money, we're going to hire someone to build it. Historically, what you're able to do is just, as you pay people to build your thing, you deduct all the expenses. So your balance sheet, for your startup company, you're not capitalizing an asset and amortizing it over time. But 2 years ago, Congress changed this rule and said you got to amortize, you got to capitalize and amortize. And the reason why this became problematic was, one, all of a sudden companies that never owed any money in taxes suddenly owe money in taxes, and now they're cutting people from their payrolls and other things because they've got to pay taxes. And the second thing it did was, all of a sudden now we have gross assets on our balance sheet, and we got to worry about this $50 million cap potentially, and not qualifying for 1202 because we run over the $50 million cap. So the 174 fix that Congress put through in the One Big Beautiful Bill Act is nice as well, because you can deduct all these expenses in the year they're incurred if they're domestic, and then you don't have this problem about running over the $50 million because you've now got an asset on your balance sheet. So, the other things I'd mention in connection with this, in the old days, and still in the current time we have now, if you, let's say you held your qualified small business stock for 4.5 years, and you received it prior to July 4th, 2025, so it's 5 years for 100%, less than 5 years for no exclusion at all, and you're feeling sorry for yourself. And actually, met a founder this happened to one time. He had started this company as an LLC. He was the sole owner of it. He operated as an LLC for like 6 months or something. Met some VCs. They said, "Hey, we'll fund you, but you got to convert." So he converted to a corporation and took their money. And so that he was okay so far. His C corporation stock qualified as qualified small business stock. But then they sold the whole thing, 4.5 years later. He didn't have his 5 years in. And the, period of time he was the LLC holding owned by him, that period of time didn't tack to his C corporation holding. So he only got, he got blown out of the water if he just started his company as a C Corp to start, he would have had his 5 years in. I mean, Congress has tried to ameliorate this, but the other thing that's always existed is this code section called Section 1045. And if you haven't heard of Section 1045, you may have heard of Code Section 1031, which is the like-kind exchange for real estate exclusion. 1031, yeah, we're talking about the rollover right now, Ken. 1031 is the rollover for commercial real estate, or used to be the rollover for commercial real estate or investment real estate. 1045 is the rollover for qualified small business stock. And it says if you sell qualified small business stock and you haven't got your holding period in yet, but within 60 days of the sale of your qualified small business stock, you invest in another qualified small business, you can attack your holding period and you can continue to work towards getting 5 years to get your exclusion. And then the other code, by the way, the other code section that comes up, or the tax code section that comes up in the context of these discussions, is Section 1244, which is a section which gives you an ordinary loss as opposed to a capital loss on up to $50,000 in losses in an investment if you're part of the first $1 million into a company. So, it's frequently the case that if you're making investments in early stage companies, if you're part of the first $1 million in, you may want to take a look at that if you ultimately take a loss, because you may be able to get an ordinary loss. And at the time of your investment, you may want to get some clarity from the company that you're part of the first $1 million in, so you get some portion of that ordinary loss if it fails. It's usually what you get when a loss occurs at the start of a company is you get a capital loss, and capital losses, are only deductible against capital gains. And it used to be they were only deductible against capital gains plus $3,000 in the rolled them over, but I think they blotted out the $3,000 now. So I think capital losses are only offsetable against capital gains now. So this idea of like you're part of the first $1 million in, up to $50,000, what would ordinarily be a capital loss you might not be able to take, that can be considered an ordinary loss you could take against your salary income, for example. That's floating around out there too in the form of Section 1244. So it's just something to keep in mind. Although I think what's evolved, and I'd be curious to see what other people have to say about this, or if anyone's had experience with this, but going back, to when my career started, for example, if you were going to buy a share of stock, you had to typically pay a fee to acquire the shares of stock. I'm talking about publicly traded shares. You had to pay a fee to acquire publicly traded shares, broker fees. And of course, that's all changed, right? Now you can buy and sell shares of publicly traded company stock for no cost. So what that's enabled people to do is instead of buying an index to say the S&P 500, you buy the individual shares, and you buy 500 individual shares in proportion to the, you buy all the shares individually, directly. And then what you do is, if you're trying to mirror an index, and you're buying all the shares in the index, well, every year, a third of any index, whether it varies, of course, depending on what index you're talking about. But let's just take like one of the big indexes. Generally speaking, a third are going to be losers every year in terms of you're going to have a loss. And so what people do is they call this tax loss harvesting. You buy the entire index, and then at the end of the year, you sell the lost positions so you can take some gains, and you'll have losses to offset your gains. And then you wait 45 days to replicate, and then you don't have to. You can take your losses. You take your losses, and you buy the whole index. So this tax loss harvesting idea, I think, has taken some of the wind out of the sails of 1244 as far as like its desirability, because in the older days, it used to be harder to play that game because you had to pay a lot of fees.
Let's focus in a moment on the angel part of tech stuff, right? So as an angel, I'm going to make my 20 investments, of which I expect 60% to go to zero and be losses for sure, right? And I expect another 30% to be more than I put in, but not a lot more. Right. And then I expect 10% to give me outsized returns, right? So one of the nice things about 1244 is as the losers lose, I can convert that, presuming I'm in the pre-seed investing thing, probability is I'm in the first $1 million round that they're doing, I can then take those off on my taxes against my regular income. So
Yeah.
that's a win for pre-seed investors, right? And
Yep.
there's this very narrow group of people doing very early pre-seed investing that win on that. And then when I get to the big returns 10, 12, 15 years later, I am able then to pay zero taxes across those. And that makes clear sense. The weird part is when they sell at, year 7 and they didn't actually say when that convertible note converted to stock. And now you have, was it really 7 years or was it, actually 3 years, because we didn't actually convert our convertible note until whenever. So there's a certain amount of record keeping consequence in the middle of this, right? Because how we interpret a convertible note, how we interpret a SAFE, and how we interpret a Series seed investment ends up processing differently, right?
Yeah, your no holding period isn't going to count toward your 1202 holding period, but you should have. I mean, there has to be a date on which the note's converted to shares, so you should be able to get that date, right?
Well,
whoever
I
the CEO of
actually
the
chased
company
that
is,
one.
though.
Sorry, go ahead.
The CEO of the company should be managing this for you, because they can disqualify all the QSBS stuff and you won't be able to undo that. So the founders you're investing in should know enough to be able to keep you clear. There's also a look forward and look back that I'm sure you're going to talk about. And if the CEOs don't know about that too, they can also mess up your taxes as an angel.
For sure. Yeah. Ken makes a good point. And you do see, like in the standard investment documents, that's, basically covenants that say, hey, the company is going to not take any action to disrupt this. And you're right. Like if you have, it's significant redemption from either related parties or shareholders who aren't insiders necessarily, but small outside share. If you have redemptions exceed certain mathematical thresholds, you can disqualify share issuances during a time period. It depends on what type of redemption we're talking about. There's two different types. One has a 1 year look back and 1 year look forward for disqualification, and another one has a 2 year look forward and 2 year look back, if my recollection is correct. But you're right, redemptions can cause a problem and cause a company to cease being able to issue qualified small business stock during this look forward period and also look back period. So that's something to watch out for. And you're right, your founders should be, looking at this and making sure they don't somehow inadvertently blow it up, because people have a lot of expectations around it.
And I've not seen any of the documents that we're seeing with safes or notes or anything that articulate any issues with QSBS. Should they?
Sorry,
the QSBS clock isn't going to start until those convert into equity.
Well, that's not what the guys doing safes are selling.
Yeah, definitely true with regard to notes, convertible notes, Ken. I think many people take the position that the safe, is equity today. It's not debt today. It's equity today. It's equity of, maybe an unknown type, an unknown amount, but equity today. And the safe says that. And so I think many people take the view that they start the 1202 holding period upon the acquisition of the safe. Now, it is true that the IRS hasn't spoken to that. But one thing that's curious about this whole Big Beautiful Bill Act amendment is, let's say you have a safe that you bought 2 months ago, and let's say it converts tomorrow into preferred stock. Well, if you start your 1202 holding period tomorrow, when it converts into preferred stock, then you're post July 4th, 2025. And once you get to 3 years, you can capture 50% of the exclusion. However, if it was treated as stock when you acquired it, when you acquired the safe before July 1st, 2025, it was treated as stock then, you're at the 5 year, 100%, no partial exclusion game. So ultimately, maybe we'll get some guidance out of the IRS on this thing. Maybe, I don't know. Last I heard, though, I think there was a sort of mass terminations at the IRS, and I don't know if this is going to make it. This has never been a I think actually from time to time this has bubbled up to something the IRS said it was going to issue guidance on, but it never did. So I don't know what the odds of the IRS issuing any guidance are on this right now. I mean, it seems kind of like a long shot. But I think many people are taking the view that if you buy a safe from a company and it's a standard Y Combinator form safe in its current form, and by the way, the current form of the Y Combinator safe says that the safe holders get paid dividends if there are dividends paid, and that was one of the question marks. I believe when the first safe came out, it didn't provide that dividend right, and so when the tax lawyers were looking at it, they were thinking, well, is it debt or equity? Well, it looks more like debt because it doesn't entitle to any dividends. How can it be equity?
Let's look at that. The practical actions you need to take. If you don't know how many shares you have, how can you pay dividends on the unknown number of shares?
It's derived from the formula set forth in the safe, the dividend amount paid on the safe holders. There's a mathematical formula, and it's basically you take the amount you paid and you divide it by the liquidity price in the safe, and then you multiply it by the dividend rate applied to the other shares of common. So it's a mathematically determinable formula under the safe. I think, I mean, it's been a quandary, but yeah, the safe, I would never call a safe a safe note. I would just call it a safe because it's not debt, and it says right on there it's not debt, and the parties aren't going to treat it as debt, and it's going to go on the balance sheet as equity. So, and there's no maturity date, there's no interest rate. It's equity. That's what I'd say.
Compare and contrast as a startup founder, like John sitting there starting his little startup thing that he's doing. Should he be issuing a safe note or a safe or a convertible note? Or should he just be doing an early priced pre-seed round in his first round as a pathway, right? Why not just do Series C documentation, call it simple, stupid, and, as a board, set a price and run with it?
Yeah, well, it's a good question because what happens is, the safe and the note, the note and the safe, they're basically both, shortcut legal documents. They're shortcuts because, what every angel investor wants, they want preferred stock, and they want preferred stock with a liquidation preference. That's sort of the starting point. Usually, if you're an angel investor, that's what you want. But if you started a brand new company and you're raising, maybe a couple $100,000 to get started, and you're going to raise it in 25 or 50 or $100,000 increments from, a half a dozen or a dozen people, friends and family accredited investor types. In that situation, pricing a preferred stock round and doing a preferred stock round is, I think the general view of it is it just costs more money than it's worth in legal and other expenses, and that's why people use these shortcut documents.
But why, if I have Series C documentation already published out there, just like I'm stealing the YC paperwork, I steal the Series C. It's been around for decades, and I just, tune it half a bit. It's not expensive. Then,
it still costs more than a safe. It still costs more than a safe to do the whole thing.
I am not clear on that.
Yeah, the beauty of the safe is if you use the latest and greatest safe from Y Combinator, which is stamped, says right on it, hey, this hasn't been changed except to fill in the name of the company, the name of the investor, the date, the amount of the investment. There's There's basically no moving parts. Yeah. So it goes faster. It goes faster. I mean, even if you have a quote unquote simple Series C financing, you're going to spend a lot more on legal fees on that than you would with a safe offering.
Can you put an order of magnitude on that cost?
Usually you're spending like $10,000 on legal fees to do a Series C financing, and like, who wants to spend $10,000 on legal fees?
Probably more than 10. Yeah,
I mean that's the low end. That's the low end. You're right. It can be a lot more expensive now, obviously. And like, if you're raising like John, you and I started a new company, someone wants to raise a $100,000 check. Simplest way to get the money is to sell them a safe.
But I'm spending $10K on producing SPVs. so that I can hit the 25K minimum already. And so well worth thinking about spending, I'd much rather have a priced round that I can just put people on the cap table directly. Ken brings up an important point that the real issue is the valuation, where I pick a random thing. And now what does that really mean on valuation? Do we agree on that or not? And range of difference between what the investor thinks is the price and what the company thinks is the price is usually significant. Ken, you want to dive into that?
Yeah, I mean, I could talk for hours on this. I was a limited partner in one of the first venture funds in Utah in '99, and then spun out and went to work for them and started my own firm. So I've done transactions a lot at like $20,000 and $30,000, where I was still trying to keep the cost down, and they just turned out to be expensive. But the issue here is really just the valuation. Like, for example, in my firm, we're raising $2 million on a convertible note, although I had not thought about the safe issue getting QSBS treatment, so we would revisit that. And then we have a $2 million price round. So is my company worth $12 million pre-money valuation, or is it only worth $6 million, right? It's the difference is, are the investors going to get, a third of the company, or they're going to get, a quarter of the company or 20% of the company? And we just don't know at the moment. And we don't want to penalize the people that are early in by saying, hey, we're going to have this expensive equity priced round. And there's not an easy mechanism to, basically refund money back to early investors. So the typical mechanism is to have something that doesn't have a valuation fixed. And, the safe notes and the convertible notes are the two easy ones to use. And that way, what happens is if somebody comes along and says, we'll do the equity round, but it's going to be at $6 million, you get twice as much equity than you do if somebody comes along and says, hey, it's really worth 12, right?
Yeah.
So that's the trade-off that you give up when you say, hey, we want to do equity. Because if somebody came along today and wanted to write a reasonable check, I would love to take it at 12 million equity, because that puts a stake in the ground and is more likely that my future valuation is going to be that high.
But at the early pre-seed round outside of California, the chances that your pre-seed company really is a 12 million valuation is really actually kind of low. And so, there's a certain amount of social expectations here that we should be talking about, right? Because there was an ACA report, I guess, when was it? The Halo report, not the ACA report. It must have been 6 years ago now, where they sort of looked at a company in Boise and a company in Seattle and a company in the Bay Area that were nominally equivalent. And the valuation ranged from 1.8 million in Boise to 3.4 million in Seattle to 9.8 million in the Bay Area for functionally equivalent businesses, right? Which is a function of the capital market, right? Not a function of the value of the company.
That's true, but it's also a function of really how much money do you need to get to the next milestone, right? So, and we have a debate about this inside of my firm. Some people think we can do it for $2 million, and some people think it'll take $4 million. But you don't want to have a $4 million pre-money and then raise $4 million. You're basically giving away half the business. That's a pretty big cut into the founders that destabilizes the company in some people's views. Even on the angel side, people think that's a little extreme.
So to dive into this rabbit hole just an inch more, I think that most pre-seed companies that are thinking they need to raise 2 million to accomplish their goals often have not thought out their social validation of their capital stack, and that there's probably 2 steps before they do the $2 million raise that they ought to be doing as a way of socializing themselves in the market. And that this notion that I can get 2 million and get my damn tech done is detrimental to their fundraising and detrimental to the process of how much you have to sell as a percentage of your company, because you're trying to take too big a bite. So I'll just leave that hang out there, Ken, and you can tell me if I'm off or not.
No, I think you're right.
Yeah.
So
and that's
starting out with your first raise of I need 2 million so I can build my prototype and get my everything, fixed so I can go find
in
customers.
my case, it's not my first raise, right? This is our last raise, but yeah.
Yeah, well, that's interesting. I rarely hear people doing notes or convertible thing on last raises. That's an interesting thought. All right. Yeah. What were you going to say, Joe?
Oh, I was just going to say, I mean, yeah, the nice thing about these convertible instruments is it just allows you to kick the can down the road on the valuation. I mean,
Right.
you put a cap on there, but the cap on there is designed to make sure, that the in the mind of the angel who put in 50 grand thinking your company is worth 4 million, if there's no cap and you suddenly convert everyone at $100 million valuation, that person feels ripped off. That person feels
Yep.
like you would never got to 100 million bucks if it wasn't for my 100,000. I should have got my 100,000 converted at 4 million or whatever. So anyway, it allows you to just satisfy that concern of that person. And that is the upper range, like if you raise money at 2 million, well, then it's basically a full ratchet mechanism, for that. They get the 2 million, they get the lower up. So I'm a big advocate and fan for the safe simply because, like, even compared to a note, I mean, notes just have more moving parts and more things for people to negotiate or want to negotiate about. Like, what's the interest rate? What's the maturity date? What's the qualified financing amount? What do the amendment terms say? There's just all these little things. And like, as a lawyer, oh man, I don't want to go back. I should say, in my experience, my clients, they don't want the lawyers going back and forth on these note terms and like running up a legal fee negotiating a note. You know what I mean? And so anyway, I'm a fan of the safe because I don't see anyone negotiate the safe. What I see is people negotiate side letters. I want some pro rata rights. Let's put it in the side letter. I want some information rights. I'll put it in the side letter. But the safe itself, you just use the form. It's beautiful. It's a beautiful mechanism. I like it. I like it myself. From a legal fee perspective, it's just a nice financial instrument.
So the counter argument I could see the IRS making, and I'm with you on the IRS is getting gutted, so it's probably unlikely that they would, is a similar argument to like if you have options as employees. The employees don't start a QSBS clock until those options are fully vested. And there's some interesting mechanisms. We have basically a cancellation clause, so our employees get full credit for those. But most companies don't have that structure. But I can see a similar argument to looking at the safe going, hey, look, the valuation's not determined, so you have equity, but until the valuation gets done. But it seems like the legal folks could do a little. I know the safe is a standard document that was put together by Y Combinator now twice, but it seems like you could do a little bit of work on that to beef up your enforceability of trying to maintain QSBS on the safe note. I think that's really interesting.
Yeah, and I think you're right about that. And I've actually thought like, I'm sure they're thinking about that. I'm sure the folks there are thinking about that. They probably already have spooled up like a handful of revisions they want to make on their next iteration.
Or do it in a side letter like you're talking about.
Yeah, and by the way, you can get your employees, if you give them immediately exercisable stock options and they exercise and they hold shares, even if those shares are subject to vesting, if they make an A3B election, they'll still start their 12-month holding period at that moment in time. And by the way, one thing I think if any of us get a chance to talk to like your congressperson or senator, I mean, it strikes me as fundamentally unfair that what the IRS does when it comes to stock in these startup companies is the IRS treats it like, back to John and I's company, say we want to pay you, $100,000 in stock to build our thing. Well, what we typically would do if we were operating in a rational universe is we'd say, okay, go build it and then we'll pay you. Okay. The problem is if we're going to pay you in stock and you're building it causes the stock to go up in value, well, then you're going to owe taxes even more so than you might otherwise. And so we play this game where we, because the IRS treats the payment of or the issuance of stock for services as if you paid cash equal to the value of the stock, and then the cash was used to pay the stock. Because the IRS treats it that way, we have to play this game where we'll issue you 4 years of stock in advance because the stock's really cheap right now, and then we'll set up so we just take it back from you if you quit. But what we really ought to do is we really just should change the rules, and we should just say, hey, if you're getting stock in a private company, which stock is not, for which there's no readily established trading market, it's unsaleable stock. It's a restricted securities under the securities laws. You can't sell it, generally speaking. That shouldn't be taxable at all. I think that could be a real, if we change that law, the way that sets out, that could be a real mechanism for real wealth sharing. Because the way it works now is people, basically workers, they get kind of jabbed. From an equity comp point of view, and then anyway, I think it'd be more just to say those shares could be transferred without any tax consequences at all, and you just defer the taxes until you get paid in cash. And then you can really share the wealth with people. Right now you got a break on it, essentially, the tax break. The tax puts a break on it.
So there's lots of little sharp edges that seem to be built into this where they're trying to create this little box, and then you get up close to the edges of the box and there's a lot of overhead to keep track of all the bits. So if I'm a founder and I have founder shares, that's a different set of sharp edges than I'm an employee and I'm getting, shares as part of my payment to being an employee, which is then a different set of sharp edges if I'm an investor, especially if I'm an investor in an SPV versus I'm an investor that's writing a big enough check to be on the cap table directly, right? There's all these little consequences of keeping track of it. Is there like anybody written out, pay attention to all these sharp edges in a document somewhere?
Oh yeah, for sure. I've got a document I could send you that kind of talks about this. Yeah, it's just a different. There's a different set of, like, in each of those three different scenarios. There's like different kind of a different set of rules for each scenario.
As a founder hiring your first employee, here is the advice you should give to the employees about, all of the tax filings you need to do and how they get, wealth out of the company. Like, giving people options is like useless for 99% of the people because you're never going to exercise those at the end, right? The financial model doesn't work. You really want to give them stock, but then you don't really want to give them stock, right?
Yeah, well, I don't know. I think because you could give employees stock that's basically just economic stock, right? It doesn't have any governance rights or any voting rights associated with it or any information rights.
So that's an interesting question. Why don't we at the pre-seed level simply give economic stock with no reporting or no signature rights to the early pre-seed investors?
Well, it's essentially what people do when they give people options. And
I don't think that the options actually play out that way in the normal case. If I have a modest return in there, I have to put cash down to get the options converted at the price, right? And even if it's a nominal price, I'm still putting out money for the opportunity to hold stock that's still not tradable.
I know I agree with you. It's not great as far as things go for the worker. And I've seen situations that, like, I knew a woman one time, she was like optionee number 4, or maybe it was 6 or something.
Yeah.
At a company that later sold for like nearly $1 billion. Okay. She'd worked there from the beginning and she was fully vested, and then she wanted to do something else with her life, She put her dues in, and then she had 90 days post termination to exercise, and because the value of the shares had gone so much, she was going to owe a lot in taxes to exercise. And so she just got let's be honest, I think she kind of got treated unfairly by the system there. I don't know. We have a Congress, or we have some people there who I think might be receptive to this idea that, like, this isn't fair. We should make the world fairer for workers. They should be able to receive this stock, just receive the stock without being deemed to receive cash equal to value stock. And tax should be deferred until they get cash. I don't know. It wouldn't cost the Treasury anything, because the way people do it now is they don't give stock to people if the stock's too valuable, because no one can afford to pay the taxes on the receipt of the stock. So you give them an option. Or, if you're Amazon or Microsoft and you're, a mega big company that has a public market, you can play the RSU game because you can set up a plan so people can automatically sell. Like, everyone at Amazon, basically has to sell some number of their settled RSUs right away simply to pay the taxes. But they have a program in place. But you can't do that with a private company because there's nobody there to buy the shares. So.
Right. So I see Ken has some questions about QSBS. Go ahead, Ken.
Yes. Okay. Yeah. I see your question there, John. Or is it? Oh, sorry, Ken. Let's do the Ken question first. Question was the QSB clock doesn't start until the C corp conversion happens, but.
Yeah, well, the thing I was going to say is you could structure a document that automatically pulls everybody out of the LLCs into the C corp. Normally, everybody wants to do that conversion, so it's not that difficult to round everybody up. It took me, more than a quarter to get that done in my case, but But basically, if you had a pharma investment and you knew it was going to be a really long hold period, you could have an LLC to start with and pick up a whole bunch of tax advantages. And then as long as there's some ratios of a certain thing and it's below a certain amount, then you just convert it over to C Corp, and then you start the QSBS clock, and you know that you're within that kind of 5 now to kind of 3-year window of having big investment returns. So you can kind of do both.
Yeah, and by the way, the exclusion is it's the greater of either 10 million or now 15 million for this new, if you get stock after, or 10 times your basis. And so in your example, what you could do in the old days, and you'd still do it, but yeah, you start your company as an LLC, taxed as a partnership, and so you operate as a partnership until you hit the $49 million in value, or now 75, depending on your scenario. And then you convert, and then you get 10 times basics exclusion. So now your QSBS exclusion is 490 million.
That's a lot of tax savings.
But by the way, yeah, I mean, there's also gifting. You can also take the 10 million exclusion yourself that you have, and you can make some gifts.
That's what I wanted to ask about. When you get to that point, I'd love to ask you some trust questions.
Yeah, and I'm not sure, John, how much time we had allotted here. Do we allot? We allotted until 1:30. Okay. Yeah, there's a New York Times article I can find and send to you that where the New York Times wasn't very happy about it, but this idea that you can basically multiply the $10 million exclusion through gifts. Yeah, we could. That New York Times article is actually a pretty good little guide to that scenario. But yeah,
there are two legal opinions on the trust issue, right? It's when is original issuance, because in order to get QSBS tax treatment for a trust, the trust has to have its own tax ID, right? So the question is, if you create a trust and it has its own tax ID and you transfer it, then do you disqualify the original start date? And some law firms will say no, and other law firms will say yes, and the IRS hasn't put a stake in the ground on this one, is my understanding.
Yeah, and yeah, for those who don't know, yeah, if it's some trusts are treated as so-called, and they're called grantor trusts, but basically they're just considered like a part of you for tax purposes. So
yeah, but those don't have their own tax ID, so those then you only have one pool. The idea is essentially I own 10% of my company, right? Because I'm not an original founder, but I have teenagers, and they would spend this. If something happened to me after we made a lot of money, they would spend it on Lamborghinis and tennis shoes, right? So they have their own trustees to manage that pool for them. But I created those trusts and put the shares when I did the C conversion. I did that conversion. Now I have friends that are farther along than I am and didn't have that advantage, and so they're trying to figure out, can they actually move those shares, or they can disqualify the QSBS treatment? And I don't know that there are any changes in the new laws for that. I think it's still a question mark.
Yeah, I think you can make gifts, but I'll send you that article. I have that article somewhere, and I can find it for you and send it to you. Yeah, I'll shoot that out to John, and he can send it to you again after this.
Yeah, Joe, if you can send it to me as well, that'd be great.
Yeah, I'll find it. I'll find it and send it to John, and he can send it around to everybody.
But do you want to hear my mixed question of pre-July 4th and post-July 4th?
Yeah.
Okay, so we did our conversion on the end of January, right? So we've got the original founders and myself and a couple employees are all on this clock. That's essentially a 5-year clock, although you can hold stuff or roll it over into other things. But we basically will convert this convertible note, or have somebody say just do the whole thing in equity, and they'll be on a different timeline. So it's great that the new rules are 3 years, because our 5-year clock and their 3-year clock may end on the close to the same date, and that would be great. But it sounds like about this 1-year look back and 2-year look back for redemptions.
Right.
How do you fit that within a 3-year window, right? You don't have 4 years for 2 years forward and 2 years back to do any redemptions within a 3-year window.
Yeah, you don't want to do any redemptions. We can all avoid it, right? And if you look in typically you wouldn't do any redemptions, right? And like you might think to yourself, well, like what if one of your co-founders leaves or something and some of their shares get recaptured? But there's a specific exclusion for that. in the regulations, termination of service related redemptions are excluded. So you really have to have a true like redemption where the company went out and redeemed a bunch of shares from people for cash because they had extra cash. You really have to do something like that to get in trouble there. I just don't see very many companies like the early stages doing that sort of a thing. But I did see it with I did see it with regard to one company's name I can't mention because everyone would recognize the name of the company, but it was a famous company that is now worth multiples of billions of dollars. And yeah, they had the classic famous company story of they thought they were going to be in this industry, and while they were in that industry, they built something that was going to help them function in that industry, and then they discovered that thing that helped them to function in that industry was actually the product, and so then they shifted the whole business and they dropped their original thing and they did this other thing, and it turned into a fantastic success story. But they actually did, in the context of that sort of pivot, they did go back to their original investors and say, hey, we've changed our song and dance, and you've been in the company for a considerable amount of time, and we're going to give you the opportunity to, if you want, to sell your shares back. I mean, there's going to be a limit on how many shares everyone can sell back, but we're going to let people get out if they want to now. And those redemptions they did disqualified them from issuing 1202 during that window. But you're right, watch out for redemptions. And it's a good idea to just, if you have a startup and people are relying upon you to make sure you don't screw up the 1202 thing, like don't screw it up. Talk to your lawyers before you do anything which could bust it. But the redemption is the big thing. The other thing is you've got to have an active trader business, and you've got to have your assets substantially deployed in the active trader business. You can't be, anyway, there's other fine points, but yeah. And if anyone ever has any random questions about this, I can't promise you I can answer every question off the top of my head, but I have been like reading the code sections and these regulations and studying these rules for like 20 plus years. So I'm pretty familiar with the kind of things you encounter here. John, you're on mute.
Yeah. So yeah, I have the question that it's really, as a founder, you just mentioned about one of the things, redemptions. So just what else the big ones that somebody really want to watch out, both for their own interest and for the early investors' interest, so that everybody goes on without too much issues here.
So,
that's
Joe, if you don't mind, I have sort of a canned speech that I want you to validate for me.
Okay.
Yeah. So if you're doing a startup where you intend to take outside money from anyone, you should just be a C Corp. There's no if, and, or but, just be a C Corp and do that.
Yeah.
LLCs don't get any of these benefits, and all of the tax things that Ken was referring to is on the sophisticated side that 99% of us don't want to deal with at all ever. And it's possible for certain people to optimize for that, but the optimization costs you money on time. In addition, if you are hiring people, you need to give them advice about their taxes, like filing their 83B kinds of things right away, and not pretending that they need to go find out about it. And most of these things don't have nasty cliffs like the 83B stuff has a nasty cliff, because once the time's passed, you can't recover it. So, you can be around for a long time, still have QSBS work. You just have to worry about the size of the company and the appropriate stage. So doing your fundraising so that you're in the capital stack appropriate stage and behaving appropriate to the stage makes all the difference, which is back to the, find milestones that are appropriate to your stage, achieve those, validate what you're doing, build relationships with the next level above, and maybe even the level above that as you move forward, because the investors really want a video, a movie of your progress, not a snapshot of your progress. And so the first pre-seed fundraise is really insight to the Series A investors about whether you're a competent startup. and then it'll lead you into being able to have that conversation in 18 months, 2 years. Did I say anything wrong, Joe?
Yeah, that was pretty good canned speech. It's pretty good canned speech. Yeah, I liked it. Yeah,
All right.
I think you're right. For the vast majority of startups, if you find to raise money from third parties, and a lot of times, by the way, like I mean, I guess I would say probably in most of the instances I'm involved in, I mean, most of my founders aren't dumping a ton of their own personal money into these companies most of the time. I mean, I've obviously done startups where, I did a startup one time with some folks who came out of one of the big tech companies, and each one of them was going to put like a couple $1 million into this thing, and they're going to hire a ton of people, and they wanted, and this was back in the day when the rules were a little different than they are now, but they wanted to optimize for the flow through benefits, all those things that we're funding. But most of the time, what I see happen is I see founders who've they've stuffed enough money away in their own personal bank accounts to go for some period of time, right, without any salary or much salary, and they don't typically like take their own capital and run it through the company's payroll again, because it's usually money that's already post-tax money, and kind of makes no sense to take post-tax money and run it through a payroll system again, right? It doesn't make any sense. Put money in a company to pay.
Unless you're in Estonia, where anyway, no.
Yeah. So in any event, yeah, but in most instances, if you're going to go raise money from third parties and you're trying to build a company to ultimately sell it, just do a C corp to start, save yourself the pain and headaches. And so many things can happen in the, you may have experienced this, but so many times, like the LLC just introduces complexities and things that you wouldn't necessarily even think about, and those complexities end up costing you, time to figure things out. And like a great example is you start as an LLC, and then you raise money on a convertible note in the LLC, and now you've got debt, and if you have debt over basis on conversion of the LLC, you can cause taxable income to occur and be deemed distributed to people or allocated to people, and all these little problems come up that people don't necessarily think about when they think it's going to be easier to start as an LLC, and it actually turns out to be more difficult. And they didn't, unless you're putting a significant amount of money into the LLC, that it's going to come back to you in the form of tax deductions flowing back to you. I mean, there's no personal benefit, or not much personal benefit if you're not putting a lot of capital in to flow back to you. So yeah, I highly encourage people to start in the C corp format if they plan to raise money. So
we end up creating SPVs as a way of consolidating a bunch of things on the cap table and stuff that are functionally LLCs. Although in Europe, we're seeing a lot of people using trusts instead of LLCs or that kind of thing.
right.
And we generate all those problems for angel investors because of that LLC.
Right.
And so is there a way to do what you just said for angel groups so that groups of angels can band together to make an investment without generating all that tax complexity with the LLCs?
Yeah, for sure. I mean, and we talked about this before. I mean, you don't have to form a so-called juridical entity to pool your funds. Like you could just form an unincorporated partnership. No filing required with the state, no annual fee to keep alive. And you could even cause that unincorporated partnership entity to elect out of subchapter K so that it doesn't file partnership returns. And it's merely a title holding mechanism. So if we all came together, the 6 of us on the phone or whatever, 5 of us on the phone here, I guess now, and we each wanted to put 10 grand in to buy some shares in XYZ startup company, I mean, we could each put 10 grand in, and then the title holding company could be, named whatever we want. XYZ title holding company, and it could hold the shares for the 5 of us as an unincorporated entity, which elected out of subchapter K. And then you wouldn't have any annual tax return either. I mean, the entity is just sitting there holding the title for all of us collectively. We'd have an agreement between us on it, but I think that would be a lot easier because you're right. Once you form an LLC, then you got the annual filing report, you got annual fees to keep it alive, register agent fees, and you got, although many people, won't file an LLC tax return at all until the actual liquidity event. So a lot of times people will just say, okay, yeah, there was fees to start the thing, we've incurred fees, we paid people, blah blah, but we're not gonna actually file a return until the end date. And even if that might cost us some of these, the value of some of these incidental expenses as deductions, because maybe they lapse out time wise or something. Just the hassle of doing a tax return every year for incidental activities is expensive and mind numbing.
Right. $750 a year to pay for the $35 fee that you pay each year.
It just doesn't make sense, right?
Right. Yep. Yeah. Well, I'll have to go offline and have a conversation with you about that at some point.
But a trust might work. A trust could theoretically work too, right? Although a trust is a separate taxpayer, or can be,
Yep.
and so it might not be might not be as good as what I think my idea of the unincorporated partnership that lets out subchapter K is.
Right.
I'm fond of that idea.
So there's a group in well, we need to write it up in the Washington context, but there's a group in Estonia called Uniborn that uses contracts as a mechanism to make all of that happen, right?
Yeah.
And they basically personally write a contract between each other, and then away they go. And the costs are 1/10 the cost of setting up anything in any other group. So
yeah, that's what you essentially have in my scenario. The unincorporated partnership would have an agreement. So we'd all sign the agreement and we'll say, hey, we're each putting in the money, we reflect on Exhibit A to buy these shares. Shares are going to be held by this unincorporated entity called XYZ Title Holding Company or whatever it's called. And we're going to elect out of subchapter K, not filing tax returns.
Right.
Yeah.
I definitely did chat more about that. But back to the topic at hand, Brent has been the person who has been most quiet so far.
Oh, okay.
Brent, is there any question or thought you want to do before we call the end of this?
No, I'm pretty good. I guess it would really be nice if we come up with somebody that's experienced using the 1202 with safes and accomplish success and so forth. While we were on the discussion, I used Copilot and I had it do a deep search and and of course it's saying nope, it doesn't count. So
it's going to give you that. Even if you use, I think even Grok will not give you the right answer. But if you want to, I mean, I have tax CPA friends around town, and we come to a different view. We come to a different view than what Grok or Copilot comes to on this question. I mean,
it's well, and I know there's been some discussion. I don't know if you've seen the little article that Ron Wiener posted on LinkedIn about a modification to the Y Combinator Safe 4 to add a couple other provisions to it, and they've always had discussions like, well, okay, so we're not on the actual cap table, but we're on a side cap table, and so we can count that. And,
well, you're on an equity ledger. I mean, the company is going to have an equity ledger for the safes, so you're on the equity ledger.
Yeah, so they're kind of counting that as we'll rely on that.
I think you're going to see people who take the position that the safe is the equity from the start, and they're also going to take the position maybe sometimes that if the safe converted after July 4th, 2025, they're also going to take the position that, well, I wasn't stock until after then. So they can follow for the 3 years. You might even see a taxpayer take both positions on the same tax return.
Yeah.
I mean, I'm not saying it's going to happen, but probably somebody out there is going to do it.
Yeah, it'd just be nice if we had some stories about them actually doing it.
Yeah, and I agree with you that it does seem like, and that's one question I kind of have. Like, I'm kind of with you, John. Like, what's the aversion to just saying that people are buying common stock, which common stock, will be adjusted, the amount, and if there's ever a preferred stock offering, it'll automatically go. Why not just issue common stock and have it convertible into preferred, just like the safe, so that there's clearly stock owned? Why not just do it that way? Like, what's the aversion? The only thing I could think about there is, angels don't like common stock, but that's sort of historically
no reason you can't have multiple classes of preferred stock with different sets of rules. You just have to be very clear about the differences between them. This one has voting rights. This one has MFN rights.
Yeah.
This one has redemption rights, blah, blah, blah. But there seems to be a hesitation about issuing classes of stock for some reason.
Yeah, I don't know. Maybe that'll be the next evolution of that thing, though. And it is kind of unfair sometimes to ask these kind of questions because the context in which that document was initially drafted is now things have changed quite a bit. Things have changed quite a bit.
Sure have.
And it's just like the LLC thing. The LLC is like the LLC statutes originally grew out of the partnership statutes before the IRS issued the check the box regulations. But realistically, what should have happened was the LLC statute should have grown out of the corporate statutes because the corporate statutes were a lot. They were a lot more well developed. They made a lot more sense. They could have literally taken the corporate chapter, the Delaware Business Corporations Act, and they could have juked that and made that the LLC statute and just not called it a corporation. And then you would have had like a governance regime that people understood a lot better than this governance regime that evolved out of partnership law. But at the time they originally started this LLC experiment, there wasn't the check the box regs, and they were trying to fit in under the old Kittner regs. So it's just a bunch of convoluted nonsense, really. But yeah, it seems to me they could fix the safe to make it clear on these points for sure. Why not just sell common stock with these conversion rights and these adjustment rights? And then you could still make it non-voting common stock, or sign all the voting rights to the CEO by proxy.
Let's take one step more down that and then call it good. So what would it take? Ken is starting his business. He's going to create a class of stock, which is a preferred class of stock with no signing rights, no board rights, just an opportunity to convert it later under certain circumstances, and just take a price round for people coming in. What's the class? What's the cost of creating that class?
Yeah, I still think you wind up in that stupid. Even if you use the Series C documents, you're still going to end up spending, more than you'd spend on deploying a safe.
Well, but I'm not using those documents. I'm creating a class of stock. It's a stock.
You still need to file. If you're going to create preferred stock, you're still going to have to file something with the state to designate the shares preferred and to ascribe a liquidation preference per share to them. State the rights, preferences, and privileges of the preferred. So in your instance, no voting rights.
And so that all has to be filed with the state.
Yeah.
And that'll cost me how much to do that? Order of magnitude. Am I paying $1,000, $10,000, right? Okay.
Something like that. More than you want to spend on lawyer fees in your
But I spend that already on SPVs.
Yeah, I think you got to change up how you do the SPVs.
I think for all the definitive answers here and everything, we need to consult this book by this guy Joe that has all the answers. And of course, this is a special one because I have a signed copy of it.
Wow, that's so cool. That's so cool. Thanks for showing that off. I appreciate that. That book took like 10 years,
Yeah.
But I'm kind of proud of it still because it's really not that dated. It's somewhat dated a little bit. Because when that book was written, most notes dominated the landscape, not safe so much. But I don't know if you saw that latest CARTA data from the CARTA data storyteller guy who's so great on LinkedIn, whose name I'm forgetting right now. Anyway, CARTA's got this great person who writes these great articles, and he reported like 75% of these convertible equity raises now are safe rounds.
Mm-hmm. Yep.
So safes are really dominating. Although, I think maybe in markets outside of like Silicon Valley and Seattle, and maybe in the middle of the country, notes are still more common than safes. Maybe. I don't know.
Yeah, I'm still seeing a little bit of both, and also a number of my recent investments have been preferred stock.
That's good.
Yeah, and but do take a look. Go out to LinkedIn and look up Ron Wiener's post about modifying the current YC Safe 4. What they're doing is addressing some of the criticisms. So when when Matt with New Gem presented at Alliance of Angels last month, and as soon as he uttered safe, there were a few people that just started getting belligerent almost, because they had had a bad experience with one of the recent exits, whereas the people that had the convertible note made out better from the exit than the people that had the follow-on safe. And so they were still kind of tender. And so between Matt and then follow on with Ron, they came up with these additional provisions that they added to the standard. And yeah, it'd be nice to see what your impression is.
I'll look for it.
Yeah.
We had a problem with one of our investments where they used the YC document, but the early YC document, and there are, consequences to that choice that were unhappy. And we ended up trying to fix the YC1 document with a side note, a side letter to tune it up a little bit. So I don't think people fully understand the consequences of no cap, or even the consequences of a cap that is too small for where the round is, right? There's edge effects of caps that are significant, which need to be thought out. I appreciate the conversation, Joe. I'm glad that you were able to come and do this. We should definitely do more collective conversations about how to make this go. Are you running any events anytime in the near future? Any Angels and Beers or any of those kinds of things?
I don't have anything like that planned right now. Those were fun, but yeah, those were fun days. We used to have these events. Yeah, we called them Angels, Pitches, and Beers. Those were pretty good. But yeah, I don't have anything like that on the calendar.
All right. Well, we're starting to do those in Europe, and so we picked up that notion. Although we tend to be a little more angel focused and a little less pitch focused, but nonetheless. Gotcha. Next week is Seattle Tech Week. Hopefully we'll see you out and about there.
Definitely will. Hopefully. Yeah.
We're definitely structuring our workshops over the fall now. So if anybody has questions they wish that we would get folks like Joe to come talk on, please drop me a note. I will take this recording and post it up on the YouTube channel. If you're not currently following the YouTube channel, please do that. Thanks so much, everyone.
Thank you, John. Thank you, everybody.
Thank you, John.